Not a problem.
Welcome to the Ask Skinny podcast with a guest. I'm proud to present Tom Bernard. Tom, welcome to the show.
Hey, thanks, Peter. It's great to be here.
Tom, please tell us more about your story and what's your background? What do you do? What's your passion?
Oh, great question. Um, I've been involved in financial services for my entire career. I got started very interested in it when I was in university. Like many people, my parents got divorced, and as a result of that, the financial strain put all of the burden on me. So I had to get educated on finances very quickly. And in addition to just earning income, trying to understand what can I do to grow my income or grow, put my income to work, and got very interested in investments. Started to do everything I could to learn all about it, and made many mistakes, whether it was investing on margin or over aggressive and listening to people that I probably shouldn't be. So I had the good opportunity to make money during the dot-com boom, but also lose a lot of money during the dot-com bust. And as a result of some of the lessons learned came around to indexing, and specifically the S&P 500, as being kind of a tried and true investment that I've been able to rely on over time and for decades. And now, as I've continued to kind of mature, not only in my career, but in some of the educational work that I do, I've taught classes at City College in the personal finance space. I've got a couple kids and have tried to educate them on investments and finance, and just spent a lot of time talking about the S&P 500, clipping articles, etc. And after a while, realized that there was a pretty significant body of knowledge that should probably put it in a book. It's widely, it's a widely held investment. Many people have access to it. So really the objective of writing the Index of America was just to give people a solid base of understanding of not only the history, but my perspective on how it works in terms of overall the earnings driving the growth of the index ever higher, and kind of the constant replenishment of companies being added and removed by the index committee, so that as the economy and business overall evolves, the index is constantly not only keeping up, but kind of beating, if you will, many other forms of investment in terms of returns for the investors.
Tom, would you agree that index fund and index investment is the best risk to reward ratio or has been for the past like 50 years? And even uneducated investor that do not want to take or assume huge risks, but they want um, their portfolio to grow either for retirement or part as 401k. Uh, would you agree that the index is the way to go because you have risks that are directly connected to the U.S. economy and rewards that are or then and then that you are the average person that is not highly skilled in finance gets the best reward for the last 50 years if they invested in the index fund.
I think you said it well. And I always like to point back to a quote by Warren Buffett that he put in one of his newsletters, that his advice to his wife when he passes is to put 90% of her money in the S&P 500 and the other 10% in short-term U.S. Treasuries. So I follow very much a similar approach. I'm a little bit more conservative. So in terms of my risk management, I have a slightly different allocation, more like 70% to 30%. But going back to the S&P 500, so the term index is thrown around very often, and so we're specifically having a discussion about the Standard and Poor's 500. So that covers 500 stocks, the 500, not the largest, but 500 very large stocks in the US, and they compose approximately 85 or 90% of the total value of the US stock market. So there's about 4,000 stocks in the US stock market. The 500 that are in the S&P 500 capture about 85 or 90% of that value of all 4,000. And then if you take another step back, those 500, when you look at the publicly traded companies in the world, there's about 13,000 or so, they represent more than half of the value of the publicly traded companies in the world, right? So when you invest in the S&P 500, you are investing in more than half of the value of the publicly available stock market value in the world. So that's one of the things that I find very beneficial in the sense that you have one simple investment with huge exposure um, to all of the sectors. So when the Standard and Poor's is created, there's a set of rules that constantly allow it to evolve and continue to, if you will, get better. So one of the primary thresholds is the value of the company. So right now it's about $22.7 billion. So a company has to be worth that much to even be considered eligible to getting in there, right? And the index committee, a committee made up of people, make the decision on what goes in and what comes out. So it is not just rules based. There is an actual committee of individuals that are making that determination. And one of the factors that they consider is what's known as the global industry classification system. So there's about 11 sectors, and they want to make sure that the S&P 500 represents all of the sectors in kind of a market weighted fashion. So right now, the largest sectors, information technology, communication. We've heard of the Mag 7. They're all in that sector. It makes up over 30% of the total value. But there are other sectors, and the leading companies in each of those sectors are in the S&P 500. So should there become a time when information technology is no longer leading the way, the if you own the S&P 500, you are owning the leading companies in the other sectors, whether it's healthcare or financials, et cetera. And when those come up and they increase in value, you're already owning it, and you will benefit from that increase in value. One of the facts that a lot of people don't realize is that a very small percentage of companies drive the vast majority of the value um, of stock market value. And so there's a professor at Arizona State, Henrik Bessenbender, who's done some studies. He analyzed the last 100 years of US stock performance, I think over 30,000 companies he analyzed, and he compared them or benchmarked them to 30-day US Treasuries. So the threshold was you had to beat 30-day US Treasuries. And less than half of the companies, less than half of the 30,000 companies even beat 30-day US Treasuries. So they didn't really add value at all. And when you look at the total value that was created, it was about $90 trillion. Less than 4%, less than 4% of the companies were responsible for that value creation. So of 30,000 companies, only 4% helped to create that value. And so it's very, very difficult for someone to just pick at random a company and have it do well. So one of the things about the S&P 500 is there's 500 companies, a group of professionals is managing it, selecting the best companies in each specific sector, making sure that they're included in that. And as long as you own the S&P 500, you own that basket of good, that basket of companies. And so, Jack Bogle, the guy that started Vanguard and he started the first S&P 500 index fund, he had a saying that it was basically like, don't look for the needle in the haystack, just buy the haystack. And if you buy the S&P 500, you can be pretty confident that you are going to be buying those small section of companies that are creating the value.
Okay, so basically, average investor, or let's say average American that wants to be investor, the safest way is to go with the index fund. And my question, before we wrap up, I would like to ask you where to start. Where should they turn? Uh, I believe your book should be the number one thing to read, and then decide where to go, where to look for a broker that will help with the 401k and all this stuff. What's your advice?
No, thanks, Peter. I appreciate that. So there are many good brokerage firms. The largest ones are Vanguard and Fidelity and Charles Schwab. Personally, I use Vanguard. I invest in the S&P 500 mutual fund. The symbol is VFIAX. They have an ETF equivalent, VOO, and that is the equity component of it. And then there's also kind of a fixed income or a risk-free component of it, and I just keep that in short-term U.S. Treasuries. And it's important to have the balance, right? Because there is risk, and the market goes up and goes down, and so you want to be able to have balance. And then every year you pick your allocation. Like I said earlier, my allocation is 70% S&P 500, 30% short-term Treasuries. Every year on my birthday, I see whatever the value is, and I just make sure that I balance it back to 70% and 30%. So if the S&P 500 has gone up a lot, I sell it down to 70% and put the rest of the money in the short-term Treasuries, and then I can sleep well at night. But everybody's different. And so I'm a big advocate on sleeping well at night, reducing stress, right? So making sure that you can sleep, be comfortable with your investment, sleep well at night. Maybe for you it's 50-50 or 60-40, whatever that is, but that is absolutely critical because the market goes up and it goes down. And sure enough, right now we're at almost record highs over 7,400, but it will go down. And one of the fun facts of the S&P 500 is it's been around since the 50s, but it was initially started when two companies, Standard Statistics and Poor's Publishing, merged in the 40s, and they had to create a new baseline for their index, and so they measured the overall value and productive capacity of the U.S. economy in the 40s over 3 years, and they came up with a base value of 10. And when the S&P 500 started in 1957, it was at 44. And now today, that same base of 10 and the value that was 44 in 1957 is at 7,400. So clearly it has gone up over time. But where people get into trouble is when they kind of dance in and dance out, and they'll buy it when it's high and they'll sell it when it's low, because emotion plays such a key role in investing and in your own personal behavior, which is why it's very important to understand your risk tolerance and make sure that you can kind of stay the course. That's the critical thing. And so it's better to be more conservative and stay the course than it is to think that you're can have a high risk tolerance and be aggressive. And then when there's a correction or something goes, the market goes down, you get a little bit scared and you jump out.
Tom, thank you for these amazing insights. Before we finish, where can our listeners and viewers get in touch with you?
So the easiest way is on my website, indexofamerica.com. I also have an Instagram page at Index of America, and I'm starting a YouTube channel at Index of America. So any of those places, you'll be able to find me.
Tom, thank you for these amazing insights.
Thanks, Peter. It's great to be here.